How's it going, everybody? Welcome back to the Invest in Wealth channel. Today's video, we are going to be taking a look at my top 5 Canadian dividend stock picks. As you all know, we are in a bit of a dip here in the markets. There's some great buying opportunities. And in this video, I'm going to share with you my 5 best Canadian dividend stocks that I'm watching and that you guys should add on your watch list too. Without further ado, let's just hop right into the stock picks. First stock we have is Canadian Utilities, ticker symbol CU. Right now, this stock is trading at $30.02. This stock, like all utilities, is having a tough time during this high interest rate environment, as most stocks on this list are. That's just kind of how it goes in times like this. But last month, Canadian Utilities is down 7.3%. Last 6 months, they are down a whopping 17.7%. And the last year, they are down 22.21%. So for those of you who don't know, Canadian Utilities is a dividend king here in Canada. That means they have raised their dividend every year for the last 50 years. Taking a look at their dividend yield, they are paying just under 6%. Canadian Utilities does pay out quarterly. Taking a look at this chart over all time, they are up 402%. But why I like this stock now for value, looking at the 5-year chart, Canadian Utilities does have some strong resistance at the $30 mark. So I think we are nearing the bottom on this stock. As you can see, this is a good buy when it does hit 30. There is some support, but again, you can't just go off technical analysis, but it is what we have been seeing here in the past. So moving along, their 52-week year range, we have their low, which we just hit today, I believe, which is $29.96. So this is at a 52-week low right now. 52-week high, $39.87. I see no issues for Canadian Utilities to go back to the $40 range once the interest rates do start to lower. They did actually just hit $40 not too long ago, just back in May. So first pick is Canadian Utilities, our dividend king here in Canada. Next up on our list, this is from the telecommunications sector. Some of you guys may know this as Bell, but this stock is BCE, ticker symbol BCE. So this here, like I was saying, it is a telecommunications provider here in Canada. You may be familiar with TELUS. I chose Bell over TELUS just for personal preference, but they are both great buys right now. Taking a look at the 1 month, Bell is down 7.3%. The last 6 months, they're down 12.5%. The last year, about the same, 12.8%. The last 5 years, they're about break even or up 1.47%. So Bell, like I was saying, the telecommunications sector really does get hit hard in these high interest rate environments. This just has been on a down run, just like TELUS has. Basically, in the last year or so, this stock does pay out a 7.3% dividend yield. This is a massive company, about a $50 billion market cap. 52-week low, we did just hit this today as well. So it was $53.06. 52-week high, $65.66. So if you did buy into Bell at this price at $53, there is a ton of capital gains that you could actually receive, as well as you're getting that nice 7.3% dividend yield. You're kind of just getting paid while you wait for this to hit its previous highs there. This stock was actually a $73 stock back in April of 2022. I do think fair value for Bell is in the mid 60s, $60 to $65 range, but this price has fallen well below that. So I do think there's some great value here. This and TELUS. So this is definitely a stock that I'll be watching and adding into. Moving along to our next stock. This is Canadian Tire Corporation, ticker symbol CTC.A. This is another Canadian dividend stock that has some extreme value as of late. They also do pay a nice 4.64% dividend. Low PE ratio of 10.54. So there is some great value here with Canadian Tire. Market cap 8.75 billion. 52-week low 139.24. 52-week high just under 190 there. So let's take a look at the last month. Canadian Tire is down 3.46%. In the last 6 months, they are down 12.75%. And in the last year, they are about break even. And then the last 5 years, they are down about 1.67%. So right now, Canadian Tire trades at just under $149. Before they released their Q3 earnings, it was trading at about the $190 mark. So I do think there is a lot of room to grow with Canadian Tire. I do think this drop has happened just because when you go to Canadian Tire, there is all the big ticket items. I feel with how the economy is right now, people aren't spending, thousands of dollars on things for their yard, new snow blowers, appliances, things of that nature. So I do think that's why this steep drop happened after they released their earnings. But I think this is a great buy right now for Canadian Tire. And like I was saying with Bell, you can just kind of hold this and just collect your 4.64% dividend while you wait for this stock to grow. So that is Canadian Tire. Up next, we have Canadian National Railway, or CNR. This stock is normally referred to as a growth stock here in Canada, but with the value that this is providing right now, this stock, I just could not keep this off my list here. They do pay a smaller dividend compared to the other stocks I was talking about, but it is still 2.11%. And for this growth, it is definitely worth picking up some CNR here. Due to how this is correlated with the interest rates and with the economy, this stock is providing some extreme value right now. Their 52-week low is 144.71, which it did hit earlier this year. And as well, we did touch that 52-week low just a couple weeks ago, actually. Their 52-week high, 175.39. This is a massive company, almost $100 billion market cap. Their PE ratio, it's cheap for a growth stock. It is 19.23. But taking a look at the 1 month, CNR is down 1.68%. The last 6 months, they're down 4%. In the last year, they are about break even. And then in the last 5 years, they're up actually 30%. But this stock coming off its highs. There is some great upside here to buy a quality long-term company. So this will fit in almost anyone's portfolio, whether you're just a dividend investor or you are a growth investor. CNR is at fantastic value for pretty much any portfolio. I'm definitely going to be grabbing some more shares of CNR. This deal is just too good to pass up on. Just look at this chart. This is basically what you want to see in a growth stock. Plus, as well, you just collect that nice income of 2.11%. So that is CNR. And our last stock on this list, it is Enbridge, ticker symbol ENB. So this stock right now is trading at $46.37. There are another huge company here in Canada, market cap of just under $100 billion. They pay a nice juicy dividend of 7.66%. They pay this quarterly. PE of 24.81. It is cheaper than its peers in this pipeline sector. But taking a look at the 52-week low, it did just touch this earlier in the month here. It is 44.86. 52-week high of $56.37. So Enbridge just announced some news earlier this month here that they are acquiring a few companies down in the States. So this is going to be making Enbridge the largest natural gas distributor in the whole North America. So this company has a massive pipeline network all across North America. They transport crude oil, natural gas. They have natural gas storage as well. So this is a great quality company. It's very hard to replicate a company like this. You pretty much can't. So in the last month, Enbridge is down about 1.72%. Last 6 months, they are down 7.78%. In the last year, they are down about 10%. In the last 5 years, they're up just about 11.25% there. So this is just a quality stock. I love their business model. They pay a huge dividend of 7.66%, and they do raise this quite frequently, almost every year. So this is a stock that is at a great buying opportunity right now. It normally trades in the high 50s, so you're getting some great value too. And like I've said with a couple of the other companies here, you just basically sit back and collect that 7.66% while you're waiting for this to bounce to its previous highs there. And moving forward, I do see Enbridge shifting more into that renewable power. So this company can actually change their business model to fit the probably the government regulations that are going to be coming into effect in the future. So they can shift from kind of the not dirty energy, but they can switch to that clean energy. They are investing quite heavily in that renewable power sector. So I do see Enbridge with some great long-term growth opportunity. This is a great hold for your portfolio, and that just a big nice yield is just icing on the cake. That just about wraps it up for this video. Hopefully you guys learned something new and took some value away. If you want, feel free to check out my other videos. I do portfolio updates. You guys can check out what I'm holding here in my portfolio. But yeah, thank you guys so much for watching. Make sure to leave a like and subscribe if you enjoyed, and I'll see you in the next video. Thank you. Bye.